From underperformance to outperformance, the rebound in the Nifty IT index this year has been nothing short of spectacular. Now, last year, this index had given negative returns to the tune of 25% and was among the worst sectoral performers. Cut to 2023, this index has given 7% returns on a YTD basis, emerging as the top performer among other sectoral indices. And this, while the benchmark Nifty 50 is down 1% so far this year. Meanwhile, it's the complete opposite for banks in 2023 so far. Now, in this video, we take stock of the divergent moves in both the IT and banks and what stocks are analysts betting on from these two sectors. But before we do that, don't forget to like and share this video and subscribe to the Moneycontrol YouTube channel. Now, a set of inline quarterly results, moderate deal wins and buy on dips calls from analysts seem to be boding well for the IT sector. Though fears of a recession in the US and Europe and reduced client spending continue to linger, several large-cap IT companies signed billion-dollar deals in the third quarter. Moreover, in a recent report, Kotak Securities says that the recession view for the developed markets holds, but with reduced intensity. In fact, the recent US retail sales data print points to a stark recovery, and interest rates seem to be nearing their peak with most of the rate hikes behind us. All these factors seem to be working well for the IT companies as a whole. The street anticipates the slowdown in global IT spending at about 3 to 4% against 6% and 8% in 2022 and 2021 respectively. In this backdrop, Jefferies believes that large-cap IT companies will emerge as winners as there is an extraordinary high barrier to sign large deals. Infosys remains the top pick for analysts and brokerage houses, given its superior revenue growth. Moody's expects 13% revenue growth for Infosys compared to 8% revenue growth for TCS in FY23. Moreover, Infosys surprised investors by raising its revenue growth guidance during the Q3 results announcements. For Jefferies, Infosys is the only pick in the sector. Bernstein analysts have outperformed ratings on TCS and Tech Mahindra as well. Now, they like TCS for its billion-dollar deal playbook and Tech Mahindra for its reasonable valuations. They have market-perform ratings for Wipro and HCL Technologies. So, IT may be turning out to be the big winner for 2023, but it's the completely opposite picture when it comes to banks. Both Nifty Bank and Nifty PSU Bank Index, which were the star sectoral performers of calendar year 2022, have been underperforming this year. Nifty Bank was up nearly 20%, while Nifty PSU Bank gained a whopping 50% in 2022. Compared to that, benchmark Nifty 50 gave modest 4% returns in 2022. Now, in this calendar year so far, Nifty Bank has declined 5% and Nifty PSU Bank has declined somewhere around 10%, both underperforming the benchmark indices. So what are the key triggers for this underperformance? Well, one is the Adani factor. The Hindenburg report flagged that Indian banks, especially the public sector banks, have large amounts of Adani Group's debt on their books. Now, this was quickly refuted by the banks as well as the RBI. The RBI Governor Shaktikanta Das said that the domestic banks' exposure to this group is not very significant and the system is strong and large enough to not get impacted by a single case. So what else could be troubling the sector? Well, most of them fired on all cylinders when it comes to Q3 performance. Analysts expect margins to decline over the next 1 to 2 quarters. Why? Because banks' margins had quickly expanded last year due to faster repricing of loans, especially retail loans, that are linked to external benchmark rates. Now, banks are always quick to hike interest on loans when repo rate increases, but not on deposits. As a result, NIMs have grown 50 to 70 basis points over the past 1 year. Now, scope for margin growth may still be there, but experts say that now is not the time. That's because repo rate is inching towards peak levels and now liabilities are getting repriced higher at a faster pace compared to loans. On top of that, fight for deposits is getting more intense and growth in loans is becoming weaker. As pressure is likely on both growth as well as margins, the consensus estimate of 18% net profit growth for banks and 15% net interest income growth in FY24 looks a bit stretched and the actual numbers could disappoint, says Nuvama. Now, in this context, most brokerages believe that investors should shift their stock preference towards Tier 1 banks from Tier 2 banks. That means optimism is higher for HDFC Bank, ICICI Bank, Axis Bank and SBI compared to other banking names. Meanwhile, broking firm Jefferies believes PSU banks might have some more steam left in them as they are still trading at 70% discount to private sector peers despite the run-up in 2022. Well, for more such videos, keep watching Money Control.